All right, welcome everyone to another Rocket Dollar educational webinar. We're excited to have Invest on Main Street here as a guest today with Patrick Grimes. And just, you might have been to these webinars before, but why do we do them? There's not a lot of education about the self-directed IRA space or the alternative space, whether that's real estate or other alternative investments. So we bring in investment issuers to come here, do education, so you can get to know them a little better, ask questions, and get a better understanding of the space. So please do feel free to ask questions. I'll let Patrick kind of dictate the pace, but if I see a really good question, I'll interrupt and we'll make sure we'll answer that question live. The other ones that may not be so related, we'll answer them more to the end. But if you got a good one, feel free to let it fly. So Patrick, thank you for being here. How about you introduce yourself?
Thank you, Brendan. I appreciate that. Thank you for having us on to meet your followers here. My name is Patrick Grimes, work with Invest on Main Street. I work for everybody in the company. That means I started it, founded it. We do alternative investments in assets like multifamily and real estate, as well as some energy investments. We have some debt funds, some recessionary funds that allow investors such as yourself, accredited investors, the opportunity to diversify out of the stock market, diversify out of Wall Street into things that are more tax advantaged, inflation hedged, recession resilient. The goal being I was once an engineer slaving away and I loved it, but it wasn't really going to get me where I wanted to go. And I was socking everything into 401k and IRAs and realized that I needed to diversify into something off the traditional path of that. And so it was a long journey getting there, and we'll talk a little bit about that today. But I found a sweet spot where we're diversified now and feeling better about the financial outlook, and I'm sharing that with others.
Great. All right. Thanks, Patrick. Let's get your slides up here. I know you got.
It's going to be a two-step. So.
Oh, it worked. It went into the right mode finally.
All right, there we go. So I'm going to do a little organizing. Just let me know when it's the right time to get started.
Oh, we're good to go. We're live. Chris, feel free to go as soon as you're ready.
Okay. So the title of the presentation today is it's called The Upside of the Downturn. And it's a little bit of a theme of my investing career. I started back in 2006 and 2007, and that was the best time to invest in real estate because things were never going to go down. They had just been going up and up and up. So I dove in head first. I took some advice and I invested, and I lost it all, which we'll talk about in a second, and then was humbled early on. And now we find ourselves in another recession, and the purpose was, how do we give back and to the Rocket Dollar group, and how do we share a little bit about, through the ups and downs, what are things that help to build recession resilient portfolios, and how do we do deals today in today's specific type, which is a little different than past recessions. How do we do deals now? And so, like I said, I'm the CEO and founder of Invest on Main Street. It's also passive investing mastery as well. I started out, as I mentioned, machine design, automation, and robotics. I have a master's in engineering and an MBA as well. Tend to be a little bit of a systems guy, so a little analytical. In this picture of me, I'm actually up on a man lift over the manufacturing floor, where we actually designed and built these one-of-a-kind custom pieces of equipment. So this machine over here on the lower left was a flue tester machine that made 200 flue tests an hour, and that was converted over to a COVID-19 diagnostic test machine during COVID. Actually, back here in the back corner, this is actually the robotic assembly cell that put together the rotor for the Tesla Model S. That's the rotating part of the motor, and back behind my head here is a Lockheed satellite solar cell assembly machine, robotic assembly. So did a lot of really cool stuff, very challenging, a lot of fun and excitement. But I was given some advice early on by the founder of the first automation company I worked for. I've always been a bit of a tinkerer myself. He said, "Hey, you're really good at this automation stuff, but you should invest in real estate as much as you can and as soon as you can." And that stuck with me. And like I said, it was back in 2006 and 2007. So I I looked for the highest returning deal, and I could find. Was very ambitious, really wanted to go for it, and I very quickly lost it all. And this is makes me squirm a little bit in my seat looking at it, but this is actually the development. I did pre-development that caused it. We're going to go a little bit about how that happened and what went wrong. Well, I invested in a pre-development. That means you're buying something that doesn't cash flow, and you're buying land with nothing on it. And so you're trying to not only do development, which typically developers will buy entitled land and stuff ready to go, but I was trying to get the maximum return, which means I'm going to get in there before there's anything, and we're going to create value by parceling out land, and then from the parceling out, then we're going to build. So it's like a two-step, even before development. And challenge there is that you're kind of speculating. That there's nothing around that says, hey, once you develop this land and put a building on it, that you know what the rent's going to be, you know people are going to buy it, and there's a big bridge of time from when you buy the land to actually going through the process of getting it ready to develop on, and then developing on it, and then during that whole time, you've got to buy it, and you don't have any income from it. And the lenders are not very interested in taking the property if you default. They want you to personally guarantee it with everything you own. And I didn't really realize that back then, what it meant. Like when people buy their own single family home to live in, they're signing on it in their own name, and they're signing on the loan in their own name. And they're doing that in order to get better debt. Because if you try and buy something in a company, well, there's nothing to protect the bank, because they can't come after you. They have to go after the company if you stop paying. So back then, I bought a property in my own name, and I signed on the loan in my own name in order to get the best interest rates, the highest leverage, meaning the smallest down payment, buy the biggest property I could, and very aggressive. Obviously, people still do this today, but what I didn't realize is what cross-collateralization meant. And that means when you buy something in your own name and you sign on the loan, that means that if you default, they don't just take the property. If you're buying it in it's called a recourse area, they can come after you and everything you own. So you're kind of cross-collateralized. And if you're interested in kind of this whole thing, and the single family world is similar. If you type in Forbes asset protection, you can see an article in Patrick Grimes, article I wrote talking about the whole issues with asset protection associated with that strategy. And so that's what happened to me. I was highly leveraged, balloon payment. I had everything I had all in one investment. I didn't have diversification, and I was focused on the hare, not the tortoise, on the high returns. So I lost it all. I came crawling out. I was very successful, so I dove back into the engineering full force, got a master's in engineering and an MBA, became very successful again, learned about recession resilient markets. And Elijah here's on the call. He works with me on investor relations, and me and him worked together a decade ago doing single family homes in recession resilient markets like Houston, where instead of developing, I was buying properties that could cash flow on day one or could quickly cash flow. I could do a measurable improvement. And this was a big improvement from what I was doing before, less speculation, more investing. And then I founded Invest on Main Street when I realized that, hey, look, this single family stuff, I'm moonlighting it with my engineering career. And like many of you, I was working hard and I was good at making income. But I was like, well, I want to be a DIY investor. I want to have control over where I put my investment. So I'm just going to do it myself and do single family. Well, it turns out I was trading time away from my family, trading time away from my friends and my hobbies, and moonlighting. And it was actually came to a critical point when I met my wife. And that's when I said, look, that's my last single family home. And my wife was there for my last single family closing. And then I said, and then I was able to marry her because I needed time, right? I couldn't be a DIY investor, which glamorized out on the TV all the time, right? The flipper companies and, like all these seemingly happy couples out there flipping homes. It turns out if you do that full time, that's great. If you're working a day job and trying to do it, moonlight it, that's tough. And you're not as skilled as some of the other people you can invest with. So we decided to partner. And we scaled. When you're partnering, it doesn't make any sense to do single family. When you're partnering, you want to buy properties. You want to partner with people in better markets than you live in and buy better investments, larger ones that scale and they're lower risk. And so we traded into multifamily, and we founded Invest on Main Street as a private equity firm. We now have, and so then at that point, I started kind of becoming a little bit of a thought leader in the space. I write for Forbes. I've got a best-selling book out. And if you want to go to investonmainstreet.com/book, I'd be happy to offer a free copy of that out to you. We send a hard signed copy out. But now I speak on stages such as this one, and we offer investments. Our goal is to help investors diversify. And like many of you, I was very much on the left-hand side of this. You know, the middle-class income goes mostly into pensions or principal residence or traditional investments in the stock market. Very, very little. In fact, it shows 8% of their investments are in these alternative investments. And that's the work until you die path that I was on. And then when you get the higher income, which is where a lot of us graduate towards, now you're like, well, how do I diversify like the wealthy? How do I accelerate retirement and make a retirement that cash flows and doesn't dwindle down to nothing? Well, in order to do that, you can't just stock things into a 401k and then dwindle it down until you pass. You need to start diversifying to cash flowing and appreciating alternative investments. And so it looks like the upper income are at 25% alternative investments. And then the ultra wealthy are at 50%. So looking at 25 to 50% of your net worth into alternative investments, well, how do you get there, right? You've got to find partners, because you can't just be a doctor, dentist, attorney, and to become an expert in a diversified amount of alternative investments. You need to find the right partners that have a track record, decades long of success in those alternative investments. And that way you get your life back. And that's what we help do. Another example of this is from the Tiger 21, and it shows very similar stats that the Tiger 21s are on the wealthy side, if you don't know. And the alternative investment makeup is about 27 in real estate and 26 in private equity. Traditional investments, hedge funds, income, commodities are on the other side. And so through that process, we've helped build this portfolio. We're a little over 600 million that we've acquired. I think we're almost to 5,000 units at this point. And I had 25 or so communities across seven states. And you notice that these tend to be the landlord-friendly states. These tend to be the recession-resilient states or locations. And there's a reason why, right? Because when I came out of the last losing it all, be the hare, not the tortoise, and focused on high returns and not risk-adjusted returns, I learned a lot. And Brendan, if there's any questions, feel free to just jump out. You know, I'm very much a back and forth type guy.
Yeah, well, I kind of turned my camera on before, but I was saying I actually invested in a pre-development deal recently, and you know, during COVID, land in Texas, you know, of course, just going insane all over the place. But you know, there's no property or multifamily ready on these two pieces of land. The construction costs have skyrocketed, and lending has seriously contracted. So, you know, like you said, these are two gem pieces of property. I don't need to say where they are, but they're in pretty desirable spots over the long term. But the investors just really can't sustain that. You know, there's not enough capital to sit on these gem of the places for 5 or 10 years. Whereas if there was a property there, the investor group probably could have hunkered down much harder for the next 3 years until some better conditions. But so now those properties will basically be forced to sell probably much earlier than they'd like to, and probably not. You know, the buyers have a much more aggressive stake compared to what they would have had just 2 years ago, or maybe 2 years from now. So just learning something from your lessons learned. I'm learning that currently right now, the last 3 months or so.
Well, so I hear lots of stories like that. I've lived it. So yeah, I can feel your pain. And I'm not saying that none of your portfolio goes towards those kinds of investments, but those kinds of higher returning, more aggressive investments may make sure that they're isolated and not cross collateralized, because they can go south, right? If they're not cash flowing on day one.
Yeah, and we had a question come in, you're using the recession resistant term, and I think we'll probably get into this more, but can you just give us a quick overview of what recession resistant means?
And there's a nuance here because there's nothing that's recession resistant, like, or there's no watch that's water resistant. Water to a level. You take that watch deep enough, it's going to crack. So it's how to build resilience into your portfolio for what factors we know can shift during a recession, and so we can only look past and in the past and see, well, what kind of economic turmoil has our country seen, and how do we adjust our forecasts and build a financial foundation for our investments moving forward based on what we know in the past. And we're going to adjust a little bit about that. And I say recession resilient, meaning, well, let's look at the past recessions and see what happened, and then let's moving forward, keep our eyes wide open. And in fact, all of my multifamily deals, we have a line in there that says, underwritten with an eye towards what happened in 2008 and 9, and not what happened in 2010 to 2020, or 2010 to 2019, I think is what we had. Because there was a time when things went south, and then there was a time when we had steady growth. So you need to make sure that these investments are built to last through these recessions. Now, the reason why I'm making is because now we have, which we're going to touch on, very unique environment today, which we didn't have before. There are different factors today in today's recession or in today's economic climate, which are unique. And so we'll talk about that in a minute. But how do we build recession resilience based on what we learned in past recessions up until today, right? Or up until call it a couple of years ago. That's what this slide's all about. Any other questions, Brendan?
That's it. Great. Let's get into the slide.
Okay. So what did I do? How am I going to do things differently? And how did we build what the portfolio we have today to ride out recessions that we knew of, the factors of recessions that we had seen, is to buy existing construction, not to try and invent something. Have there be no bridge from the time that we buy it and it cash flow and pay its own bills. That way, if the market fell apart, we would be able to continue to ride that out. And so we buy for cash flow. Low leverage. You've got to take a look at your break-even occupancies, meaning at what point does your vacancy at what point does your vacancy prevent you from being able to pay your bills? So you need to put enough debt down so that you cash flow high enough to break even at the occupancy levels that we have seen in past recessions. And that's different depending upon your market. So in some markets like Phoenix and Las Vegas, and we saw it during the 08-09, it took 12 years for those to recover. Well, you can't invest in those at all. But we saw in some other areas like the southeastern states and Texas, we saw it maybe take 1 or 2 quarters on up to 3 or 4 years. And not only did they stay fairly stable, but the vacancies only dropped 10 or 20% in those areas, even in the 08-09. So if we put enough capital down, we raise enough capital, and we get a small enough leverage that allows us for a strong cash flow, that allows us to pay our bills even in a downturn, then we won't likely become distressed. Still pay our bills. So it's about doing low leverage, not what I did, 90% loan to value. So that's what I had before. And believe me, there's lenders out there pitching that all the time. And so then with that debt product that you need to get fixed debt. Most of our portfolio is all fixed debt. It wasn't until a couple years ago that we did a few projects with floating rate debt. And floating rate, a fixed debt's like what you have on your single family home. Everybody's got fixed debt on it. Most everybody's got fixed debt on their single family home. But a lot of commercial assets are done with called bridge debt, which is equivalent to hard money in the single family residence space. And they don't want to fix the interest because they want to make some money on your deal. But you can buy an insurance policy, which is like a hedge. It's called a rate cap. And it's a separate, it's not, you don't buy it, you can buy it from your lender sometimes, but typically you shop it on the open market. You can buy a rate cap. So if you're getting a loan for a large commercial piece of property and it's not, Fannie or Freddie like you do with your single family, it's not fixed debt, and you're buying something with a variable interest rate, then you need to go also shop for a rate cap. And then that would mean that you're going to pay a certain amount, that if the interest rate gets to a certain level, then anything above that insurer will pay. And that's what a rate cap is. And you need to make sure, go ahead.
Yeah, and I say correct me if I'm wrong here, but the two places I typically see like real estate syndicators or real estate space feeling pressure is they signed up for a loan that's completely free floating, and obviously interest rates have drastically changed in the last year and a half. Or with the bridge, they're consistently going out for more bridge rounds every couple of months or years, and they need to continuously talk to different lenders. And now, so they might be getting new loans, but the terms of those new bridge loans have drastically changed. Is that correct, Patrick?
Yes. Yeah. So it's either they buy floating interest and then they keep hoping to shop new loans, right? Either because the interest rate's high and they want to find a smaller interest rate, which is really tough to do, or because the loan terms were short. I mean, some of these loan terms, so I should have said long-term rate cap or fixed. Sometimes these people are buying 9 months, year, 2-year loans. And even if they buy a rate cap, then it expires in 1 to 2 years. They're in a lot of trouble right now. In fact, there's $1 trillion in debt coming due just in the next year. And, there's going to be called the debt walls, what they call it. It's a lot of people that have bought short-term debt. That short-term debt is prevalent in most construction projects, new construction. So the space that I'm at here is really on where lenders are willing to lend fixed rate debt, which is in existing construction, cash flowing, producing assets. And so that's why we have the luxury of these kind of longer term fixed interests. There are some construction, it's very difficult to get, like HUD loans or some construction at fixed interest. But so buying that rate cap means that the interest rates can still go up. The interest rates can go up and they can consume your income, but you need to stress test your deal. You need to make sure that if you're going to buy a rate cap, that if the interest rate does go up to that and you're having to pay more to the cap, that you can still pay your bills. So you need to make sure that when you're buying something that cash flows, to you're putting enough down payment to make sure that the cash flow is strong enough to cover a recession, the vacancies in a recession, and also strong enough to pay your bills even if you meet your rate cap, right? And so that's what I learned from as downturns. And then a lot of the people buying brand new assets out there, they're buying stuff at the top of the market and they're saying, hey, the market's going up and we're planning on the market appreciating. And so I didn't like that, right? Because I wanted to create value. I wanted to go to work and not hope. I wanted to invest. And so a lower risk way to approach it is to say, with all that in place, let's also buy something we can get at a discount. It's very quickly we can raise that value through doing renovations or doing value add. So it means we just don't go buy any property. It means we work very, very hard to find properties we can get a good deal that still pencil with a high down payment, that we can still pay a rate cap for, and that are below market rents, that we can see clear comparables around it, that allow us the ability to raise those rents through renovations, where we can say, hey, like this is an old renovation property, it's 200 to 300 below the other one. Now, with all that said, you still need operating reserves. There's some projects out there that just raise exactly enough capital to take down the property, and then they hope the lender will give them the money to improve it. They don't have any balance in their account. And what we found is that if a fire happens or there's a tornado, which is the next hurricane, you have to have a lot of reserves. Even if you get a replacement cost insurance policy, you have to foot the bill and you have to wait it out. You have to float the funds for that insurance company to pay out the flood. Pay out for, sorry, I tried to make a joke there. It didn't really work out for me, but I know Elijah's laughing at that one because he loves puns. But so with insurance policies and with traditional things, a fire in a building, and we're going to talk about some of those, you need to have operating reserves. So we have 6 to 8 months of operating reserves, meaning we can pay our bills if we get no rent for 6 to 8 months. And that lowers our return even further, right? All these things, risk-adjusted return, meaning you've got to find the right investors that are willing to not invest for the highest return like I did and risk it all, but willing to buy something that will survive a recession. So, and to find the best properties, it's workforce housing, resilient markets. I think at this point we kind of go into, and what's our time check?
We're about halfway through, so let's keep moving briskly here through the rest of the presentation.
Yeah, so an example of this strategy is an investment we purchased in Jacksonville, Florida. This was called Canopy Creek Apartments. I think it was 320 units. We worked very hard to find this. It wasn't something that was on market. This was an off-market deal. We were told by a lender that the owners were struggling because one was deathly ill and the partners wanted to exit. The lenders were worried about the possibility that he may pass and the partners not be able to keep the property going. They made an introduction so that we could jump in there and see if they'd be willing to sell it. And they were. We put in an offer. Not a single unit was renovated. They were way below just a apartment buildings, just right around it, across the street and around it. The rents were way below. We were able to swoop this up. They wanted to exit quick. We didn't have time to go raise the capital. So we approached a family office and the family office put up all the capital to close it. And then we did a capital raise after the fact to backfill the equity. So that's an example of working hard, finding a property you get at a discount, that you have a motivated seller, a performing property that's cash flowing on day one, but there's a lot of value add strategy to it. And we bought a rate cap on it. So this property we were able to turn around in 10 months and we sold it. We bought it for 27 million, sold it for 37 million. And we 1031'd our investors into a subsequent investment in Texas. This is another example of people who didn't take the principles that I described to you before. This was Westbury Reserve in Texas. And I remember because we were living in Hawaii during that time, and in this apartment, and I flew red eye because we heard that this, again, from a lender, that this guy was in trouble. Most of our deals actually come off market or pocket listings from brokers. Just a couple of them came from lenders. So we flew out there, and this guy had a 19% bad debt. 19% of his residents weren't paying. He was in trouble. He needed to exit quickly. The lender was not willing to give him time, and he had fallen delinquent on his debt coverage service ratio, meaning that you have to have that property healthy enough or else the lender can take it. And so it was an example of not having the reserves. In fact, during this whole time, he didn't keep the property up. When we walked the units, we found molds, floods, foundation issues, pests, fires. We found everything, and he just had let those sit. He had just run the property into the ground, and as a result, the tenant stopped paying, which made his problems worse. He didn't have the income to keep the property up. He drained all his reserves, and he was trapped. He was stuck. And this is kind of a testament to, if you don't take care of your residents, they're not going to take care of you. In fact, when we're, go ahead.
Yeah, and just hearing something I thought was notable, these lenders in their position, like, they don't really want the properties. They don't really want to repossess them. They'd rather pass them off to what they see as another responsible operator that they can have a better relationship with than the previous.
Yeah, I'd agree. I'd say the right lenders that you want to work with are those. There are loan sharks out there. There are the loan to own type players, but the ones that invest to sophisticated outfits like us, they're ones that are not the take back loan to own type type, and they want a strong operator in those properties.
Mhm.
And so this one was incredible. We got in there for an amazing discount. Like I said, 90% bad debt. When we did the due diligence, we found a stack of unanswered maintenance requests, the thickness of a ream of paper. We printed out the unanswered maintenance, just a ream of paper, and it kind of frustrated me. And we went to work, made it a cleaner, safer, and improved living experience for our residents. And we got some long-term fixed debt on this, and it's an amazing cash flow play with great appreciation. In Houston, recession resilient market, right outside of the med center area, life science center area. So it's another example. City Park, this is an example of both needing reserves and needing replacement cost insurance. This in Atlanta, this property had a whole building burned down all the way to the pad. And the guy didn't have a lot of money. He was struggling running the property. I think he had like a 15% of the rents weren't being paid. The rent, he ran out of money. He didn't renovate the unit, so he couldn't increase his income. Then when the fire happened, he got a payout, and then he just ran. He just didn't see his way. He didn't see a way to get out of this because he didn't have the reserves to float the property when the fire happened. And in the meantime, he just drained the property down. Residents stopped paying, and it's just a spiral. So on the other hand, if he had had 6 to 8 months in reserves, he had the replacement cost insurance, he had put up enough down payment so that he could cash flow, he would have ridden out this natural disaster, this fire, and it'd been a huge win. Why? Because on the other side of it, he would have had a brand new building paid for in replacement costs that appreciated and enhanced the value of the property. It would have all been paid for. And oftentimes these natural disasters to the right operator can be a huge win. But when an operator doesn't have his act together, it makes a big win for us because we can get in there and get a discount. We can save the day. And that's an example of how this one happened. We're running out of time. I'll probably skip this guy. This is another example.
We have a full hour, Patrick. I just wanted to let you know that it's at 12:35. So we'll go to 1 Central Time, which is about 25 minutes from now.
Okay. Easttown was another example where I flew out under cover of darkness, red eye from the island, landed in Dallas. And this was an operator that had defaulted on 4 properties outside of Texas. He is actually based out of the Bay Area. He had defaulted on 4 properties, and the various members of his team were reaching out to qualified people saying, look, a lender cannot consume 4 large properties all at the same time, even if they wanted to. It's just too much. And so this was another example of a broker comes saying, look, I sold these guys these properties, and we need to get some of these offloaded immediately. And so we went in there, and it was, again, neglect. The capital had not been raised to improve the property. They were just essentially taking it out on the tenants, his own financial problems on the tenants. They obviously stopped paying. It was just littered with trash. Everything was outdated. And we moved very quickly to get it under contract. This is in San Antonio. This is a really cool project because this is a C class, sort of like that workforce housing. Typically, we would go a little bit nicer, but the pool was drained. Everything was dilapidated. This was probably the nicest picture in the whole property. None of the units, over 200 units, not a single one had been renovated in decades. And so as a result, we're looking at $600 below comparable rents. And again, this one had a building flood, and that entire building had been shut down. And as a result, the income was just catastrophic for the owners, which is a great opportunity for us to get in there, make a cleaner, safer, and improved living experience for our residents, while being the source of relief for the owner and providing great returns to our investors.
Question I had, Patrick. Oh, we have one Q&A here. Let me just check that. When you see a lot of PE firms targeting similar properties, What's your competitive advantage in landing some of these deals? Is it personal relationships or something else? Michelle asked.
Yeah. Yeah. So it's all people. In all of these cases, these are not shopped out there on the open market, right? So it's making good on a broker. You think about whether it's a lending broker or it's a property broker, they're just people trying to put food on their family's table. They need an operator that they trust that will close. If they try and shop for the biggest, highest price and they put it on the open market, and then the owner may twist their arm into taking the highest price. Well, if it's the highest price, they may not be able to secure the financing. They may not be able to close. And if they're paying high prices, they're probably not the most sophisticated buyer. It's far better that the broker give it to somebody who they know will close, because ultimately the broker doesn't care if a $20 million property goes for 21 or 22. He needs it to close. If he fails to close it, the owner is going to be angry at the broker and may choose a different broker. And those relationships are relationships for life. And so the brokers really want that transaction to happen, and they want to manage the owner's expectations as best as they can to try and achieve not the highest price, but the highest likelihood of closing. And they know that when they give you a property, if you use them to sell it, then they've developed a repeat source of revenue to put food on their table. So they're more likely, if you've used them before and you bought a property with them and you list it for sale, they're more likely to bring you other deals, because they see those as ongoing revenue streams for them.
And how long does a closing process of some of these properties take? Because I think that was something, a learning experience I had. This can either be very long or short compared to the experience level of the operator that's trying to buy the property.
Yeah, so like in the case of Canopy Creek, we did a 30-day due diligence, and then we did a 30-day close, and we just closed it with family office funds. So we brought in a large, and that's about the fastest I've ever seen a commercial asset. It can be 45 to 60 days just for due diligence and then your earnest money goes hard. And then it can be 90 days plus, to close with extensions on top of that. So there's a big range. There's been cases in which investors have invested, sent money into an investment, and they've called me and said, look, I wired my funds in for the investment, but it's been like 4 or 6 months and they still haven't closed on the property, and they just keep extending. So it can be a challenge. To get things closed, especially in today's environment with the lending landscape changing, which we'll talk about in a couple minutes here.
Yeah. And one last question I had, we can answer it quickly and move on. You talked a lot about tenants not paying at some of these properties. When you come in kind of with new management, do you see that come up, or is it kind of like the relationship is soured and it's either they have to leave the property or get evicted and put a no better paying tenant in there?
Yeah, it's a spiral that happens when operators do not look after the tenants. They don't hire the right people. So they let the wrong kind of tenants in, and they don't invest properly in marketing and then they don't invest in the look and feel of the property to get the right kind of tenants in. And then what happens is they have a lot of delinquencies, so they don't get a lot of money, and then they stop improving things, and then they get more of the wrong kind of tenants in. And then they start getting bad reviews because they're not fixing things. Well, they don't have the money to. And there's this spiral that happens that owners get into. And so when we get in there, the first thing we do is improve the safety. First thing we improve is the curb appeal. So that, and the first thing we do is renovate the first unit, right? Get the pool working. We do all the outside stuff. And then we actually camp out and we look to see where the riffraff is. It doesn't take a lot of time. Well, if there's riffraff at a property, we'll put up cameras, or we'll put a security guard, or we'll camp out and see where people are coming in and out all night. We'll talk to the tenants, look at the past reports to see where the riffraff is, and we'll move very quickly. And we do walk all the units, so it's pretty clear to see where the problems are that are preventing it from being a cleaner and safer place to live. And so we'll immediately begin turning over the tenant demographic. And that is, there are lots of tenants which are there, which are great residents. But oftentimes when we do the lease due diligence, we do the lease audits, they haven't put any deposit, so they don't have any incentive to keep the place up. They haven't done any background check. They haven't done any past income checks. So when they go to renew, they have to reapply. And oftentimes what we'll find is a large portion of them don't make it. And sometimes if they've been on there for a long time and they've been payers, we get to choose to keep some of those. If they haven't, it's time for them to move on. And when they see the new management come in and they see the property get lifted up, most of all of our properties we buy, the pool's been drained. And it kind of warms my heart when we see the kids jumping in the pools because I'm like, you know what, it's hot out there. This is some hot areas. And it's really cool to see when they see the place and they see somebody taking care, they see maintenance people show up and pest issues fixed. And they want to be a part of something like that, because if they go shopping, they're going to see that we're doing a better job than the people around us. So you'll see people turn into better renters, but you will see a pretty big turnover, especially when we bring in higher quality management on the property. You will see pretty significant turnover of the residents.
Yeah, it seems like the operator not taking care of their best tenants just means you're going to continue to get lower and lower quality tenants. And with 2 stars on Google, what are you destined to get more of? So thank you for answering that. So David had a question. We're doing a lot of talking about investing in recessionary times. I think he's asking, still real estate. Like, I think David's asking, like, hey, so in the times we are right now, are these kind of hard times, these hard properties that you've looked at before? How does real estate compare against some of the other asset classes?
Well, that's a great segue right into our challenges in today's market. And then I will post-it note that as we go through, because I will frame that response. And in real estate today, what you see are interest rates are up, meaning valuations are down. So what we talked about before is how we developed a strategy to build a portfolio that will ride out a downturn based on what we saw happen in past recessions. But let's fast forward to today now. How did you do deals today in today's market? And what are the economic conditions that we see in today's market? So with interest rates up, valuations are going down. Inflation increased, right? That means our rents go up. In fact, I have a whole article in Forbes discussing how rental properties is a great hedge against inflation. Patrick Grimes Forbes inflation. But what also went up is our maintenance costs, our renovation and construction costs. Both the labor costs and the materials costs went up. Well, that's going to consume a lot of the rents. In addition, what we're seeing is we're getting hit by, because of the increased amount of natural disasters, especially in the southeastern states, where are traditionally the best locations for resilient multifamily investing, we're seeing insurance premiums go up. Not just a little bit, 10, 20, 30, 50%. In some of those markets, dramatically. Whole insurance carriers are leaving those states. Whole new carriers are trying to come in because of the void. It's been, I have properties in Houston that have flooded twice, and they're in 500-year flood zones. So they're rezoning a lot of those flood areas. But yeah, the insurance premiums are going up. And in Houston, we fight taxes every year, and they're becoming more aggressive, actually. So it's becoming more challenging. Now with inflation, rents go up, costs go up, labor, construction, insurance premium, taxes. But like I said, if your operator did not get fixed interest, if they got floating interest, at the same time, interest rates going up, that consumes more of your income. So as you're getting people out and you're renovating, it's costing more to renovate. It's costing more to get the insurance premium. Inflation may be helping out and raise those rents, but that's getting hit by costs, insurance, taxes, and greater interest rate payments until you meet your cap. All of this is going on right now today, in addition to we just came out of COVID. What is that? During COVID, the whole country was being propped up by rental assistance checks. We got wild amount of money send to us for properties that just from the government of hundreds of renters not paying. And they didn't pay for years. And what happened? They didn't restart payments. So right in the middle of all of this, the payments didn't resume, which means delinquencies skyrocketed all across America. And eviction courts backed up, even in the best markets in the country. We're talking Atlanta and Houston, where we could get people out in like 2 weeks or a month. It's been 4 to 6 months. It's insane. It's so backed up to get these people out because the courts, they de-staffed during COVID. They had an eviction ban. Everything got backed up. And now all at the same time, everybody's evicting. What does that mean? The residents know that maybe they started paying, but the guy next door didn't. And he's laughing because it's been 6 months and he's still never been evicted. So they know that they don't have to pay. Now, you can underwrite very conservatively, but that's a lot to happen all at one time. You can't even get people out to raise the rents, to spend more money to renovate, to spend more money for the materials and the labor, to then try and raise the rents in order to cover the income for all of those factors. So we're trying to do cash for keys. It's been really tough. Whoops, did I lose? What happened here? And the timelines are growing. Where we used to swiftly move through and renovate half dozen a month, the renovation and construction timelines are growing. We're delays getting permitting, evictions with backlogged, and which delays the rental increases. And so which not on here is the material delays. You know, we're trying to source in materials for construction has been backlogged as well. Should probably add that one. So back to the post-it noted question, still real estate, like what else is there? There are others, and we are presenting those, not in this presentation. But let me shift and if you stay tuned, because we do have, we're not currently doing an energy investment, but we have, and we do have alternative investments outside of real estate, which is Passive Investing Mastery's whole mission. But before we leave real estate, if there's blood in the water, it's the time to figure out if there's opportunity. And, you know, Warren Buffett says, be fearful when others are greedy and be greedy when others are fearful, right? Well, when I lost everything back in 2008 and 9, I didn't have the ability, because I didn't have a portfolio built to resilient enough to ride out that recession. I didn't have the ability to pounce on the opportunities that created billionaires. The people that bought in 2009, 10, and 11 are billionaires today. So we're in one of those very interesting inflection points. And I've been waiting like 20 years for this. So how do you do deals differently today, leaning into the recession, right? Invest differently now. You make your money on the buy, not the sell. It's true in any investment, whether it's real estate, business, or the stock market. You make a return on the buy, not value add. Now we can buy and do some value add, but you don't want to. Go ahead.
Yeah, we had a question come in from John. So he asked, you know, how long are you typically holding on to these properties on average before you sell? I think that's maybe a question for historical properties. This environment may be different.
Exactly. And that plays right into this slide here, because historically we would project a 3 to 5 or 5 to 7 year longer hold because we would do a slower value add play. But in today's market, it's about making your return on the buy. So our Recessionary Acquisitions Fund doesn't project long holds. In fact, we're looking at holding these for maximum a year. And oftentimes our goal would be to trade them forward in 6 months. When you make your return on the buy and not value add, you're not relying on rent growth. You're not relying on appreciation through renovations. You buy those opportunities for motivated sellers. So we try and not use brokers in this particular case because brokers want to jack the price up at this point. There's this big differential in the market right now where sellers haven't caught on yet to the fact that they need to come down. And brokers are still trying to make the sellers happy. So there's a lot less properties trading right now. So if the broker's in the mix, they're going to keep shopping. So right now is the time to just go direct to owner and find distressed operators, not distressed assets. There's a lot of opportunities we're seeing out there where it's cash flowing buildings, and we can get it at a great buying in price, and we can make the return from there, and then we can just trade it forward in assets that are already stabilizing cash flowing or stabilize or can be in the initial couple months. It's the process of winning with the recession. So my argument right now, and the reason why I'm very excited about where we're at, is this isn't the era of value add. This is the era of buying right and trading forward, just like we saw billionaires do, billionaires that were created in 2009 and 10. Now, by holding shorter, you can compound your investment. What does that mean? I mean, if we raise capital into a fund and then we acquire better properties and we're not planning on holding them forever because we made the return on the buy, we can immediately just sell it and do a 1031 exchange or exchange into another property. Pull our capital out and then do a trade. Maybe 1 becomes 2, 2 becomes 4, 4 becomes 8, all within a fund. So we get some very exciting yield. Cash flow. If you buy a property that cash flows, and then within the fund, we pull out we're usually buying in cash, or we're using the capital from the fund to close it quickly to get the best deal. You pull out some of the capital, you buy another asset. That asset's going to cash flow. You trade this in another asset. That asset's going to cash flow. Both of those you pull out capital. Those are going to cash flow. You trade for those. So you have compounding cash flow in a fund like this. So you're not buying for huge cash flow. You're buying for some cash flow. And as you aggregate and compound through shorter term holds, it's a very different approach. You don't focus on the long-term value add. We may do some lease ups, we may do some light value add, but that's not the goal. And that's not required to meet our returns. That's what I believe is the strategy today. And you mitigate risk with the cash flow, not lengthy holds. So if the market's slowly decreasing, we're not hoping that our rents will outpace it.
Yeah, we had a question come in. I think this is just a retirement planning question, because we have a retirement audience. So someone asked, does it make sense to hold properties for a long time in a long-term portfolio? And I think you've just been getting that on the last slide, but in a retirement account, you aren't paying any capital gains tax from a sale on these properties. So, you can buy assets and hold them for 10 years, or you can sell them quickly in 1 year. There's no capital gain. It's really what's serving your portfolio best. So if you have something high risk, maybe you should have some more medium, low risk assets in there. And I think what you're saying, Patrick, is these properties, you're decreasing the risk by getting rid of them quickly, instead of a long hold could potentially be more risky in this environment.
So if you're buying a property and you're hoping that you can use value add to increase rents, and that will outpace and the rent growth will outpace the effects of inflation driving your costs, interest rates rising, lowering your valuation. That's a risky proposition to put together a deal today with, right? What's lower risk is focusing and working hard on there's a ton of distressed operators out there where you can get the properties at a very low basis, or you can get the properties with the ability to get your capital out immediately, and focus on those great buys instead of buys which require you to improve over time. And if you're in a retirement account and you buy for a long-term hold right now, I think you're missing the opportunity. Because it wasn't the case that 2 years or 4 years ago, I could come to you and say, look, we've got so much deal flow of properties we can just buy and make your return on the buy that we don't even need to improve them. And we immediately trade it forward to the next and do it again and immediately trade it forward to the next. If you're playing capital gains, we're doing it within a fund so that it wouldn't even hit you even if you weren't in a retirement account. But that opportunity, it's going to go away. The market's going to recover. It always does. You need to pounce when you can. And right now, it's about acquiring at volume, and taking advantage of as much of these great buys as you can, not sitting on a long-term hold or trying to do a long-term value add play. And that's what the purpose of this fund is to harness as much of that as you can.
Yeah, and I think, sorry, they are anonymous attendees, so I don't know their name, but if you want a long-term outlook, don't take that money out and suddenly just go put it to something else after a sale. You should be looking for either a fund, an operator, or your own strategy to be more long-term. Some strategies, even long-term, there's more volatility in the actual portfolio. As long as it's still serving your long-term goals, that's okay. And John asked a question, many experts say that commercial real estate will fall in the near term. If this is true, then wouldn't it be smart to wait for that to happen before buying a property? And before you go, Patrick, I think I'll speak very quickly. Distressed operators are starting to pop up already, John. So this might not be on CNBC all the time, or they're kind of talking about it, because a distressed operator doesn't expressively go on CNBC or go on TechCrunch, and they don't email everyone and say, hey, we're under extreme duress and we need to quietly look at a quiet sale. So, they're often quietly putting feelers out this. And Patrick, through these relationships, you're trying to identify these people before they get in too much trouble and they have 10, 20 operators trying to buy their property.
Yeah, so we're doing direct to owner. And it's very similar. That's our target market. And it's very similar to what we were doing before. I told you about deals where it was all about the operator being distressed. Maybe that resulted in some effect on the property, but there are performing properties with just owners that need the relief. They need out. And this is very unique today. This is the chance to pounce. And while you see the tide receding in your real estate portfolio, this is the chance to ride in those waves. This is a little nod to the surfers on Waikiki Beach behind me here. But this is that chance to take advantage of the upside of the downturn that will not be around in a year or 2 or 3 right now. And the faster we move to pounce, the better. And the risk profile is so much lower because you're not hoping, before earnest money goes hard, the value that we can get out of the property. And we're not hoping that we can outpace a drop in commercial real estate with long-term rent growth. So it's a much lower risk proposition. It provides better diversification because you're not just buying one and holding. You're buying one, constantly turning into 2, 4, 6, 8. So you build better diversification, both in the scale and to geography. And we're actually venturing into multiple asset types. Mostly multifamily, but there's some triple net and retail in there as well that we're finding incredible assets. And we're only holding them for a shorter period of time. So that's why I think that how to do deals today is this other strategy. If you would like to set up a call, I know we're here at the hour. I'm happy to answer any questions as this continues, but feel free to go to our website and happy to set up a call and talk to anybody about their goals. Like I said, we have a book. It was a bestseller. I hand out copies of that. I just like to inspire people. It tells my whole story. And I'm happy to share that with individuals as well. There's a link here that if you're interested in learning more about our investments, happy to make sure you opt in because we do have a wait list for the investments we have coming up. We do have not only real estate, but we have alternative investments like we've had in the past coming up subsequent to this Recessionary Acquisitions Fund that we're currently working on. But with that, I'll go ahead and answer any more questions that there are.
Great. Someone asked, is it better off to be in a REIT so you can avoid operations costs? I think that's maybe a question about your fund structure and then generally how REITs compare to that.
Yeah, so I'd go to, just if you're wanting a more detailed explanation, go to Forbes, Patrick Grimes, and then REIT. Just search for those or reach out. We can send you that, or REIT out, we send you that. I think we have it on our homepage at investonmainstreet.com. I've written entire articles on why REITs are a horrible decision. It is no different than investing into a tech company because REITs are paper. You're buying paper. You're not buying real property. Everything from a REIT is mostly taxable, except for a kind of a laughable small percentage that they give you. You can't take the tax, you can't take the tax deferred. You can't really build wealth. You can't pull out part of your investment and have the rest compound in the future. You can't 1031 exchange forward to avoid capital gains and take advantage of the most valuable wealth building tool available to Americans. REITs are a kind of a fallacy that financial planners provide to make you feel like you're diversified when really you're just buying paper. You have no real inflation hedged asset or tax advantages associated with it. So I'd stay away from REITs entirely. And I think if you follow the wealthy, they will invest in real estate. They will invest in private equity. They'll invest in stocks, but they will not invest in stocks and REITs because that's all it is. There's very little benefit there.
Okay. So not a fan of REITs, Patrick. We've got that on board. We know it now.
Right.
And this is a question we get all the time. Sometimes I don't know if we can answer this live on the webinar, but John asked what the average ROI before after tax on the projects that you're looking for investors. Patrick, you can answer that as much as you'd like, or we can have you email John after. That's up to you.
Yeah. So John, to Brendan's point, it's not normal to share openly into accredited and unaccredited investors all about our return structures. But if you go to the website that you see here, passiveinvestingmastery.com/rocket, there's an opt-in. And at that opt-in, we will be sharing soon the track record within the 4 acquisitions made in our recessionary acquisition strategy. And we do have 3 of them which have realized already and a 4th on the way, which will provide you very good understanding, the whole story of how we found those assets, the story behind the owner, how we executed, how we were able to accomplish the returns, and what gave us confidence that we could continue to find those kinds of deals at scale. And the returns are very high because, again, we're making the returns on the buy and we're holding them short term. So we do have that, which definitely helps to build confidence for the fund. And the fund that we're launching here will begin to do acquisitions instead of outside the fund with investors as one-off deals, do within the fund, which allows us to very quickly acquire much faster, better deals, allows us to quickly trade forward into compound returns, more tax advantaged. So it'll provide for much greater diversification and return over time with a similar strategy that you would see in the business case track record that will show along with this offering when we launch it.
Okay, this will be the last question. Patrick may have plenty of time, but I got to get going, unfortunately, soon.
Mm-hmm.
So someone asked, how do you quickly sell a property again? So you've just acquired a property and you said you might be selling it 9 to 12 months later. How does that sales process maybe look different, or do you prepare for such another recent sale?
I don't understand the question. How does the sales process look different?
So I think, what the person asked, you just bought this property. Is it normal to sell it within a year to these other professional operators, or do they think that's weird or strange? Just because most average people, they're not selling real estate properties in a year. They think of more like they're selling stocks in a year. I think the investor is asking, wow, that seems not very typical for like a liquid real estate property. So how does that effort and time to sell it in just 1 year come together?
Well, at Canopy Creek, we bought it $27 million in February. We sold it 10 months later at $37 million, and we sold it to an institutional buyer. Mm-hmm. So,
I think it's just providing context. Some of these institutional buyers will move much faster than standard retail investors. They're professionals, and they might not have seen that private off-market deal a year ago, or they might not have wanted it in the condition before Patrick's team got a hold of it. Is that correct, Patrick?
Yes, 100%. And I think the other thing to say is because we're making a return on the buy, we're not so worried about squeaking out every last penny on the sell. Mm-hmm. So we know the value going in before our earnest money goes hard, and we can walk if it doesn't pencil for us. But we actually underwrote selling them competitively in a short period of time because we want to have the agility to rapidly trade forward, more so and squeak out every last penny. We could spend the next 5 years getting the property to 100% and squeak out every last penny out of it. Or the next 5 years, we could own 20 properties and, many times X our income by continuing to do the major stair step forward. And while we can buy these incredible buys, take advantage of as many of those as we can.
Yeah.
And so that's really the goal. So we can sell it at a great price to the next guy after we've had it for a short period of time, and they don't care how long we've owned it.
Yeah. And I think another learning experience is, there's not a lot, sometimes there is, but sometimes there's not a lot of liquidity in the real estate space. So when the appropriate buyer pops up, to Patrick's team or another real estate operator, they're going to want to move, even if, that might be a little bit different than maybe they expected to hold the property 3 years, but the right buyer popped up in 1. You need to take advantage of that while the iron is hot, so to speak. Okay, thank you, Patrick, for stopping by today. Sorry to cut you off, but we don't have any more questions left. Please email Patrick at his email right here. We're also going to have this up on YouTube later today. If you missed a part of it, or you'd like to send it to someone else on the Rocket Dollar YouTube. Thank you, Patrick, so much for being here today.
Appreciate your time. Thanks, Brendan, and everybody that listened. Happy to speak with anybody further. Feel free to set up a call.
All right, thank you.